Perhaps not surprising when we see these labour force figures today, but is it, if I could take the glass half full approach, good news because at least we know that Victoria will largely bounce back?
Yeah, good morning, Laura. It is. And the interesting thing also, as you said, look, it is for October. The other way to look at it is that it's actually taken in the first 2 weeks of October. So when we see these numbers, they are going to be a little bit skewed because, yes, Victoria was still there, but it was coming out. And that was the other thing. You've got to remember, regional Victoria at that period of time was actually starting to expand again. And you could actually see that. And you would also started to see that the recovery outside of Victoria has been stronger and faster than probably forecasted. So although there is some fairly, reasonable decline expectations today, there are some that actually believe that we might actually see an expansion. And the top end of that range, although the expectation from the consensus is a loss of 30,000 jobs, some people believe we could even see as much as 20,000 jobs created in October. So that may actually put it to another side. It also goes hand in hand with what we saw yesterday with the wage price index, which was as expected. And in fact, it was a little bit worse, anemic. And it went backwards for the first time since we've actually seen that number being created since 1998. It all leads into the RBA. And why I go there is that the RBA has changed its mandate almost by stealth in saying that the most important thing that it will now focus on isn't inflation, it's full employment. And before the pandemic, it said full employment was 4.5%. And if we do go up to 7.1 or 7.2% unemployment, that is a very, very long way away. It probably therefore means that the RBA will be in the market for at least 5 years. Some people are even saying a decade before they could get back to sort of normalising policy, barring any other sort of mishaps like a GFC or a coronavirus of 2020.
Yeah, it's jobs, jobs, jobs. And to a large extent, Evan, we are at the mercy of global markets. And in recent times, markets, particularly Wall Street, has been buoyed on news of multiple vaccines and them being ready to roll out in the next couple of months. But there are signs that the market is starting to look through that. They're not as positive about the vaccines and it being a panacea to ending the coronavirus real disaster.
Correct. And look, the way to answer that question is that under market theory, equities particularly try to price 12 months ahead. So if you look at what November 2021 will look like, as you said, that vaccine is not just one, it will be multiple of vaccines will be on the market. The probability of actually seeing inoculations across particularly the developed world by the midway through June next year is pretty high. So that's where that initial reaction has come from. But this morning, we did actually see that the final update of the Pfizer numbers came through. It was the same actually as the Moderna of a 95% effective rate, in fact, slightly better than that. But we got a negative number from Wall Street. And what's actually probably been telling us this is the bond market in the US has been very, very nervous. Your previous story around what's going on in the US, they are on track to average 200,000 cases per day by midway through next week with the way things are going. They are also following what's going on in Europe. And those two alone are starting to show in economics, confidence has actually plummeted in the US and Europe. We actually saw retail sales in the US yesterday go backwards for the first time since they came out of lockdown. And there's also signs that output out of the US and Europe is slowing. So there is signs that in the short term, caseloads will become more and more important to how markets look. The bond market's already priced that in. Does the equity market start doing that before the end of Christmas? Probably, in terms of what's starting to eventuate.